In 2018, a rapidly growing fashion brand hit $10 million in sales. 6 months later, they filed for total bankruptcy. They weren't victims of a data breach, and they hadn't lost their customers. On paper, the business was thriving, generating the kind of profit margins most founders only dream of. They were caught in a structural timing gap, a trap that quietly destroys thousands of healthy-looking startups every year. Relying on standard growth metrics while ignoring the actual speed of cash movement leaves a business vulnerable to collapsing before the first year is even over. When you're starting out, you naturally focus on revenue. You see money flowing in and assume the business is winning. Profit is a better metric, but it can still be deceptive. You cannot pay a utility bill or a vendor's invoice with a profit margin. To keep the lights on, you need working capital. That is the physical cash sitting in your bank account ready to be spent today. Until those funds actually clear into your account, your paper wealth is effectively an illusion. Business survival depends on the movement of physical cash. Imagine your business lands a corporate contract for $50,000 worth of design work or physical goods. To fulfill that order, you spend $20,000 immediately on materials, software, and labor. The math is simple. $50,000 revenue minus $20,000 costs leaves a $30,000 profit. But clients use net 90 payment terms. On this timeline, you see the 3-month gap between delivering the work and the cash arriving. While waiting for that payout, fixed costs continue to accumulate. Subscriptions, hosting, and rent require physical cash this Friday, long before the 90-day clock hits zero. This is where the business fails. Tracking the bank balance, the line drops below zero weeks before payment arrives. This is exactly what happened to that $10 million fashion brand. They didn't lack customers. They lacked the cash to reach the next payout. Cash flow timing is the ultimate decider of business longevity. If the money doesn't move fast enough to cover the bills, the profit margin doesn't matter. Protecting a business from these structural gaps requires a defensive framework built on 3 specific rules. Rule 1 is the iron wall. Never mix personal and business banking. Separating these accounts ensures you have an undistorted view of your company's actual liquidity. Rule 2 is know your burn rate. You must calculate the exact amount of cash your business consumes every month just to keep the doors open. This calculation determines your runway. If you have $24,000 in the bank and your monthly costs are $4,000, you have exactly 6 months to live before you must generate new cash. Rule 3 is build an emergency buffer. A resilient business holds a cash reserve equal to 3 to 6 months of operating expenses, providing a cushion against late-paying clients. Implementing these constraints transforms a vulnerable startup into a business that can survive the unpredictable cycles of corporate finance. Managing these cycles doesn't require an advanced finance degree. It requires consistent software discipline. Modern accounting tools automate the tracking of these gaps, while integrated payment systems help settle invoices faster to shorten the cash cycle. A healthy business isn't defined by the numbers on a balance sheet, but by the speed and efficiency of the cash in its hands.